In 2018, I made my first trade on Robinhood app. I bought 18 stocks of Netflix and after 4 months I sold with a profit of about 11%. My first thought after that was, wow, that's so easy. I'm a financial genius. I would be richer than Graham Stephan and more popular than Meet Kevin and more funny than Andre Jim.
Wow. Okay, wow. No!
Swing trading is so cool and easy. It will be my style of trading and investing. How stupid I was at that moment. My first loss on swing trading was about $535 with a small electromechanical vehicle corporation, Solo. Then minus $3,811 with Jumia stock. The biggest loss happened later with a $7,400 with a kind of WIX volatility index that I tried to swing as well. Well, it was a painful lesson. It took a lot of time, I was nervous, I checked my Robinhood app at least 5 times per day. But at the same time, since the beginning of 2019, my dividend investment portfolio have given me about $2,000 in dividends, plus a significant appreciation of stocks I had in my dividend portfolio. And what is more important, I got all this money without any significant efforts. So this video is my attempt to answer one of the most frequently asked questions for all newbie investors, like me. What is better, swing trading or dividend investing? Keep watching. Hi, Dmitry Bonder there. I'm sure you heard that dividend investment can guarantee you stability, while swing trading gives an opportunity to get more profit, but it's much more risky. So if you want to do nothing and know that your money is working for you, invest in dividend stocks. Just do it. It will provide you predictable income as well as long-term growth potential. Guys, before I'll show all my trades and mistakes I made with a swing trading, please keep watching. Let me very briefly explain what is a dividend investing and why so many people like it. Smash the like button if you prefer dividend investing or click subscribe button if you prefer swing trading style of investing in stocks. Okay, how dividend investing works. Dividend stocks distribute a portion of the company's earnings to investors on a regular basis. And most American dividend stocks pay investors a set amount each quarter, and the top ones increase their payouts over time. So investors can build an annuity-like cash stream. But you may ask, how should you know which stocks to choose and in what companies you can invest in? There are 2 ways. The first one, kind of lazy one, is just to buy S&P 500. In this case, you are buying a very small portion of 500 US companies. Let's imagine you are laying on the couch and buying S&P 500, and then each quarter Apple, Nike, Netflix, Coca-Cola, Starbucks and other 495 companies are paying you dividends. It seems to be the perfect style of investing. But there is a second way you may use. You can buy dividend stocks of a specific company and make your own dividend portfolio. That's what I did. I personally use platform Dividend.com. It's not sponsored video, and their service provides a general ratings for more than 3,000 US companies. And based on that information, I made my own decisions which dividend stocks to buy. But there is one big problem with the dividend stocks. They cannot give you a very high return. Maybe about 2-4% per year. That's not so much. So that's why you may come to another investing style, swing trading. And swing trading is shares buying and selling in order to make money on the price difference. Usually it takes from 2-3 days, sometimes to 1-2 months for any stocks to make a swing. And this style of trading requires a lot of attention and involvement in trading process. And the key question I asked myself in the beginning of my swing trading career and practice: when should I buy stocks and when should I sell them? Okay, when I lost at least 1,000 on my first intuitive swing trading, I realized I need to be more prepared for this style of investing. I read tons of materials from different sites, and finally I found the answer for myself in the book that called How to Make Money in Stocks by William O'Neill. Author of this book proposes a powerful CAN slim abbreviation investing style. Let me explain briefly, I'm sure it will help you a lot. I realized that to make a good swing trading, I have to follow some very important rules. And according to CAN slim abbreviation, before any serious swing trade, we have to check C. Current quarterly earnings, A. Annual earnings growth, N. New product, service or management, S. Supply and demand, L. Is it company a leader or laggard, I. Institutional sponsorship or institutional investments, and M. Market direction. So in case of C, current quarterly earnings, we are checking current quarterly earnings per share, and they should be increasing by at least 25% when compared to the same quarter from the year before. An additional accelerating EPS growth in recent quarters is a strong positive sign. In case of A, annual earnings growth, annual earnings should be increasing over the last 5 years. You can easily check this information. And additionally, yearly EPS should be growing at least 25% or more over the past 3 years. In case of N, new products, service or management, there should be new things that are positively affecting company's future and driving the stock price. So a lot of innovation, a lot of new products, services, or newly appointed maybe people among the management team that will be driving this innovation. In case of S, supply and demand, the company should have a high trading volume during price increases and have a small float, fewer shares outstanding relative to other companies. In case of L, leader or laggard, the company should have a relative price trends of 80% or higher. Relative price, by the way, strength is a technical indicator and shows the performance of a stock relative to the market. In case of I abbreviation, institutional sponsorship, the company should have an increasing number of institutional investors buying the stock. All these investors, they are pushing the price up. So examples of institutional investors include mutual funds, pension plans, banks, governmental bodies, and insurance companies, big guys who are pushing the price up. And the last letter in this abbreviation is M, market direction, and stock purchases should only be made when the market direction is upwards. And what is funny, the author of this book, O'Neill, indicates that the stock may satisfy the first 6 factors of CAN slim abbreviation and still sink if the market is on the decline. I'm sure you may think it sounds really complicated. Yes, a little bit. Swing trading is not the easiest way to earn money, but the easiest way to lose money, just believe me. But there is a good news, guys. You can significantly improve your chances of swing trading if you will not be repeating my mistakes that I did several years ago. Let me explain. There are some pretty basic mistakes of a beginner trading like me. So the first mistake, prolonged holding of position at a loss. An investor under emotions, especially a beginner, usually waits until the market turns in the right direction. As a result, it leads to significant losses or loss of entire deposit. So you should withdraw the transaction when the loss is about 7-8% of the purchase price. For instance, I bought a very hype stock, Aurora Cannabis. It's a kind of Canadian licensed cannabis producer. Hold this stock for 7 months and sold with a loss. The same case happened with ExxonMobil stock. I hold it for 7 months as well. Or for example with EPAM Systems and some others. Bad, really bad strategy. One more serious mistake in a swing trading: buying an asset at a reduced value or stock that is falling. So to some traders it seems like they're buying a company at a good price. But in practice the price continues to go down and the investor suffers significant loss. You know, it's like trying to catch a falling knife. My rule of thumb right now, if I see that I lost more than 4-5%, I'm selling this stock. It's better to save money for something that is growing or going up. One more mistake of swing trading: when you're trying to fix small, fast profits and retention of unprofitable positions. In this case, the investor does the opposite. He closes profitable positions, limiting his income and growth. At the same time, unprofitable transactions remain open and reduce the total deposit. One more serious mistake of swing trading: buying all big names. I believe that the company's past success doesn't guarantee its future. You know about it. It's much better to buy a little known company on the strategy that I described, Ken Slim, than a very famous old name company without proper analysis, hoping for the strengths of their brand or their position. One more serious mistake was swing traders' purchase of shares according to rumors, news, or immediately after IPOs. So many public advisors cannot give a guaranteed correct assessment of the market situation, and in many cases they analyze the situation in the opposite way, or they're doing it very wrong way. And you know, the same is true if you are buying a share of company immediately after IPO. It's a kind of gambling. So I'm sure you have to wait for their first or second quarterly earnings report and then make decisions. For instance, I bought immediately after IPO Jumia stocks. It's a kind of African Amazon. A lot of investment portals wrote about them, how they will be growing so fast, and it was a huge hype. I bought pretty significant number of stocks immediately with the cost of $45 per share, and after 6 months I sold it about $27 per share with a total loss about $3,811. That was my painful lesson. So in total, after the first 2 years of my trading career, starting from 2018 to 2020, I had some positive positions with a total $39,000 and some positions that I closed with a loss. It was about 19,000 in total. So my net profit was about 20,000. I was actively involved in all these trades. I was pretty nervous every time doing these trades. On the other hand, with my dividend portfolio, I got about $2,000 in the dividend payouts and about 16,000 of dividend stocks appreciation. So guys, it's up to you which style you prefer. Right now I hold all my dividend stocks in my 401k portfolio, and it's growing not very fast but very predictable. My another portfolio, about 100,000, I have on Webull, and I prefer to invest in the growth stocks. But it's a totally different story and a topic for next video. Thank you for watching and peace out.